Hello my dear students, so how are you all? I hope all of you are fit and fine. In this video we are going to start the new chapter which is money market. That is a market for short-term securities. So let's have a look what are we going to study under the money market chapter. So here's the overview of the chapter. We are basically going to study about the meaning and features of money, that is the concept of money and the characteristics of money. Next, functions performed by money, that is the role of money. Next, we are going to talk about various theories related to demand for money, such as the classical approach, or you can say the quantity theory of money, the Cambridge equation or the cash balance approach, the Keynesian theory of demand of money, etc. Okay. Also, we are going to talk about the determinants of demand for money, that is the factors affecting demand for money. So let's recall it till now. Overview of the chapter: meaning and features of money, functions performed by money, various theories related to demand for money, determinants of demand for money, and along with this we are going to talk about the meaning of money supply and the components, that is the elements of money supply, or you can say what constitutes the money supply. Next, we are going to talk about the measurement of money supply, that is the calculation of money supply. Next, we are going to talk about the theories of money supply, such as money multiplier approach of money supply, or you can say money multiplier approach of determining money supply. So let's have a look. Meaning of money supply and components of money supply. Measurement of money supply. Theories of money supply. Along with this, we are going to talk about the concept of money multiplier as well as the credit multiplier. Also, we are going to talk about the meaning of monetary policy and the objectives of monetary policy, that is the aims or goals of monetary policy. Also, we are going to talk about the different components or elements of monetary policy framework. So let's have a look. Concept of money multiplier and credit multiplier, meaning and objectives of monetary policy. Next, different components of monetary policy framework. Also, we are going to talk about the analytics of monetary policy, that is how the changes in the monetary aggregates affects the consumption, expenditure, production in the economy. Next, we are going to talk about the operating procedures and instruments of monetary policy. That is, we are going to talk about the implementation of monetary policy along with the instruments or tools covered under monetary policy. So let's have a look. Analytics of monetary policy, the operating procedures and instruments of monetary policy. Along with this, we are going to cover up the organizational structure for monetary policy decisions. Okay, that is, we are going to talk about the organizational structure that is taking the decisions regarding the monetary policy of the country. So, organizational structure for monetary policy decisions. Let's talk about the money first. Now, what is money? See, whenever we need to purchase anything, if we need to purchase any good or if we need to purchase any service, what do we require? We require the money, right? So, money acts as a medium of exchange. It is basically a way of exchanging the goods and services. Next, it is act as a unit of account. Value of all the commodities can be expressed only in one common denominator, that is in terms of price, right? So the value of all the commodities can be expressed in terms of money. This is called money is a unit of account. Next, money is a store of value. We can store our wealth in the form of money. We can store wealth in the form of money in our bank account, right? So we can store the money in order to use it in near future, right? So money is anything which is medium of exchange, unit of account and store of value. So let's recall it till now. Money can be anything that can serve as a medium of exchange, unit of account and store of value. Now students, we will have a brief look on the features of money, that is the characteristics of money, or you can say attributes of money. First, generally acceptable. See students, money is accepted by all the people, right? No one rejects to accept the money, right? No one denies to accept the money in exchange of goods and services. Next, money is durable and long lasting. Money is not perishable, right? Money is durable and long lasting. The value of money remains same. So that's why it is long lasting and durable. Next, money is effortlessly recognized. We can recognize the notes of 2000 rupees very easily through its color, right? Through its size, etc. So money can be identified easily. Next, it is difficult to counterfeit the currency. That is, it is difficult to produce a fake currency. Next, money is relatively scarce but has elasticity of supply. See students, we cannot produce the money in unlimited limit, right? There is a limit to produce the money in the economy. So that's why the money is relatively scarce. But money has a elasticity of supply, right? That is, the supply of money can be adjusted. Next, money is easily transported or portable. That is, money is mobile. We can take the money from one place to another place, right? So let's recall it till now. Features of money: generally acceptable, durable and long lasting, effortlessly recognizable, difficult to counterfeit, relative scarce but has elasticity of supply, easily transported or portable. Next, it can be divisible into smaller parts in usable quantities or fractions without losing its value, right? We can give the 2000 rupees to the shopkeeper in order to get 10 notes of the 200 rupees, right? So the money can be easily divisible into smaller parts in usable quantities or fractions without losing its value. Or you can say, in other words, money is available in different denominations, right? 10 rupees, 20 rupees, 200 rupees, 500 rupees, 1000 rupees, 2000 rupees, etc. So let's recall it till now. Divisible into smaller parts in usable quantities or fractions without losing value. Now students, we will talk about the demand for money. Well, what is demand for money? See students, we can hold the money in the form of bank accounts, or you can say deposits in the bank. We can hold the money in the form of shares, bonds, etc. Also, we can hold the money in digital form. Like we can hold the money in our bank account. We can use the money through phone pay. We can use the money through Paytm, etc. Also, we can hold the money in physical form. Okay, that is, we can hold the money in our wallet. Now, the desire by the people to hold the money in the wallet, or you can say the desire by the people to hold money in physical form, that is called demand for money. The demand for money is a derived demand. Why the demand for money is a derived demand? Because the demand for money is the demand for purchasing power. Basically, someone demands for money in order to demand the goods and services. That's why the demand for money is dependent on the demand for goods and services. That's why the demand for money is called derived demand. So let's recall it till now. Demand for money. The desire by the people to hold money is called demand for money. The demand for money is derived demand. Next students, there are basically three motives for which we demand for money. Money is demanded for three motives. First one is transaction motive. Next one is precaution motive. Third one is speculative motive. Now what is transaction motive? Transaction motive means doing the day-to-day transactions. Right students? Like we buy the food items daily. We buy the fruits and vegetables daily. So the demand for money in order to buy the fruits and vegetables is called transaction motive. Okay. So transaction motive, or you can say transaction demand for money, includes the demand for money for doing the routine life transactions. Next, precaution motive includes the demand for money in order to secure the near future. That is for demanding the mediclaim, right? Through doing the mediclaim in present, we can secure ourselves in the future for any medical impairments, right? So precaution motive. Next is speculative motive. We demand the money for making money out of money. For example, we invest the money in shares in order to generate more money out of it by having the gains on the sale of shares. That is called speculative motive. Okay. So demand for money is done for three purposes: A, transaction motive; B, precaution motive; C, speculation motive. Next, students, we will talk about the determinants of demand for money. Okay, that is the factors on which the demand for money is dependent. Factors affecting the demand for money. There are basically so many factors on which the demand for money is dependent, such as the income of the individuals, rate of interest charged by the banks on the bank deposits, and the degree of financial innovation, etc. So let's have a look. Determinants of demand for money. Factors such as income, rate of interest, the degree of financial innovation, etc. See students, whenever the income of the individual would be higher, then higher would be the expenditure and higher would be the demand for money in order to do the expenditure and vice versa. So let's recall it. Higher the income, higher would be the expenditure, higher would be the demand for money and vice versa. Next, if there will be higher rate on deposits, that is if there will be higher rate of interest on deposits, then there would be higher opportunity cost of holding money, right? So in that case, the demand for money would be less because the individuals would prefer to deposit their money in their bank accounts in order to earn the higher rate of interest, and vice versa. That is, if there will be lower rate of interest on deposits, then there will be lower opportunity cost of holding money, and hence in that case the demand for money would be more. So let's recall it. Higher rate on deposits, the higher opportunity cost of holding money, demand for money would be less, and vice versa. Next students, if there are technological advancements in financial aspects, that is the financial innovations such as internet banking, ATMs, it reduces the need for holding money. So the demand for money reduces. Like students, we have the money in the Paytm, PhonePe, right? We have the money in the form of UPI apps. So we prefer to hold the money in our wallets now. So this is the example of financial innovation. So financial innovation such as internet banking, ATMs reduces the need for holding money. So the demand for money reduces. Now students, there are certain theories regarding the demand for money. We will talk about these theories one by one in detail. Let's go through the names of the theories first. First we have classical approach, that is the quantitative theory of money, that is QTM. The Cambridge approach and the Keynesian theory of demand for money. So let's recall it till now. Theories of demand for money. Classical approach, that is the quantity theory of money, that is QTM. The Cambridge approach and the Keynesian theory of demand for money. And here we have post-Keynesian approaches, that is inventory approach to transaction balances. Friedman restatement of the quantity theory. The demand for money as behavior towards risk. Okay. So we are going to study all of these theories one by one in detail. We are going to talk about the classical approach, that is the quantity theory of money, that is QTM. See students, the quantity theory of money was developed by Irving Fisher based on his observation in the 16th century. He observed that whenever there is flow of money from America to Europe, then there is increase in price level in Europe. Okay. So based on his observation in 16th century, he developed the quantity theory of money. So let's recall it till now. Classical approach, the quantity theory of money, that is QTM. It was given by Irving Fisher. In 16th century, he observed that whenever there is flow of money from America to Europe, then the price level in Europe increases due to that. Based on his observation, Irving Fisher developed the quantity theory of money in the year 1911. Okay. He basically developed the statement of the theory that there is positive relationship between the price and the quantity of money. That is, if the quantity of money in the economy will increase, then it will lead to increase in the price level of goods and services in the economy, and vice versa. That is, if the quantity of money will decrease in the economy, then the price level in the economy will decrease. So let's recall it. Based on this observation, Irving Fisher developed the quantity theory of money in the year 1911. There is a positive relationship between price and quantity of money. Also students, we know that the value of money is basically the purchasing power, right? And we know that value of money and price level is inversely related to each other. That is, whenever the price for goods and services will increase in the economy, then the purchasing power will decrease. That is, the value of money will decrease and vice versa. That is, if the price level will decrease in the economy, the value of money will increase. Let's recall it till now. Value of money and price level is inversely related. That is, when price level will increase, then value of money will decrease and vice versa. That is, when price level will decrease, value of money will increase. Now students, he concluded that whenever there is increase in the quantity of money in the economy, then price level will increase in the economy, and due to increase in price level in the economy, the value of money will decrease and vice versa. That is, if the quantity of money will decrease in the economy, then the price level in the economy will decrease, and hence the value of money will increase in the economy. Okay. So Irving Fisher explained the relationship among quantity of money, price level and value of money. So let's recall it till now. Quantity of money will increase, then price level will increase, value of money will decrease and vice versa. Irving Fisher explained the relationship among quantity of money, price level and value of money. And from this relationship we can see that there is inverse relationship between the quantity of money and value of money. That is, whenever the quantity of money will increase in the economy, the value of money will decrease and vice versa. Next students, we will talk about the assumptions that were taken by Irving Fisher in his theory. First, velocity of money, which is abbreviated as V, is constant. Now what is velocity of money? See students, if I get a salary from Grooming Education Academy, I'll do the expenditure, I'll purchase the garments, right? Then the money will go from my hand to the hands of the garment seller. Then the garment seller will purchase the fruits from that money. Then the money will move from the hands of the garment seller to the hands of the fruit seller, right? So money changes hands after hands, right? So velocity of money refers to the number of times the money has moved from the hands of one person to another person. Okay, so under this, the velocity of money is constant. Next, volume of transactions, that is the number of transactions, is constant. Volume of transactions is abbreviated by T. Okay, and also he assumed that economy is at full employment. That is, there is full employment of resources in the economy. Next, he assumed that price is passive factor. That is, price is not determined independently. Price is determinant of various other factors. Okay, so let's recall it till now. Assumptions: velocity of money, that is V, is constant. Next, volume of transactions is constant, that is T. Economy is at full employment. Next, price is passive factor. Next students, he assumed money as a medium of exchange. He considered none other function of money, but he considered money only as a medium of exchange. Next, there is long run of operations in the economy. Long run is going on. So let's recall it till now. Money as a medium of exchange. Next, long run. Till now students, we have gone through some of the portion of the quantity theory of money. As we know that quantity theory of money was given by Irving Fisher, and Irving Fisher gave the equation in order to measure or calculate the money supply. And that equation, which was given by Irving Fisher in order to calculate the money supply, is also known as Fisher's version or equation of exchange or transaction equation. Okay, so let's look at the equation given by Fisher. That was MV is equal to PT. Okay, so where M represents the quantity of money, whereas V represents the velocity of money, P represents the average price level, and T represents the volume of transactions. So let's recall it till now. Fisher gave the equation to measure money supply, or Fisher's version or equation of exchange or transaction equation. MV is equal to PT, where M represents quantity of money, V represents velocity of money, P represents average price level, T represents volume of transactions. The students, in the equation, the multiplication of M and V, that is the product of M and V, represents the total money supply in the economy. And the product of P and T represents the total demand of money for transaction purpose. So let's recall it. The product of M and V represents the total money supply in the economy, whereas the product of P and T represents the total demand of money for transaction purpose. Now further students, we have, this is the equation which was given by Fisher, right? And the assumption taken by Fisher was V and T are constant. So let's consider V and T as constant. This implies M is directly dependent on P. So quantity of money and price level are directly related to each other. That is, if there will be increase in quantity of money, then there will be increase in the price level and vice versa. So let's recall it. MV is equal to PT. Assumption is V and T will remain constant. Next, quantity of money and price level are directly related to each other. Now students, subsequently, Fisher extended the equation of exchange to include the bank deposits as well. Bank deposits was represented as M dash, okay, and their velocity was represented as V dash in the total supply of money, okay. So later on, Fisher extended his equation by considering the bank deposits and the velocity of the bank deposits, okay. So expanded form of equation was now became MV plus M dash V dash is equal to PT, okay. So here the money supply is basically the sum of MV plus sum of MV and M dash V dash. And here demand for money represents the product and PT represents the demand for money. So let's recall it. Subsequently, Fisher extended the equation of exchange to include demand deposits, that is the bank deposits, that is M dash, and their velocity V dash in the total supply of money. The expanded form of equation is MV plus M dash V dash is equal to PT. So here we have where M dash is the total quantity of credit money which is created by the commercial banks, and V dash is the velocity of circulation of credit money, okay. So total supply of money is the sum of MV and M dash V dash, and PT represents the demand for money. So let's recall it, where M dash is total quantity of credit money, V dash is velocity of circulation of credit money. Total supply of money is equal to MV plus M dash V dash, and PT represents demand for money. Now students, there is a criticism for this theory. The criticism is Fisher's equation is abstract in nature. It is only based on observation. There is no logic behind that. The theory is based on truism, that is the observation which was observed by Fisher. There is no logic behind that. And other functions of money was ignored here. Fisher only considered money as a medium of exchange and ignored the other remaining functions of money. Also, he considered that economy is at full employment, which is totally a myth situation. The economy cannot be at full employment, right? So let's recall it. Criticism or drawbacks. Fisher's equation is abstract, based on truism. Other functions of money was ignored. Economy at full employment, which is a myth situation. Now we are going to cover up the Cambridge approach or the cash balance approach, which was the extension of the quantity theory of money. Okay. So students, basically in early 1990s, Cambridge economists like Alfred Marshall, A.C. Pigou, D.H. Robertson and John Maynard Keynes further extend the theory. Okay. So let's recall it till now, the Cambridge approach or cash balance approach. In the early 1990s, Cambridge economists Alfred Marshall, A.C. Pigou, D.H. Robertson and John Maynard Keynes further extend the theory. Under the cash balance approach, the value of money is determined by the demand and supply of money. Okay? So basically the value of money is decided by the demand and supply of money. And under this, the money is not only the medium of exchange, but this approach considers money as a store of value also. That is, the people like to save the money as well. Okay? So let's recall it till now. Value of money is determined by the demand and supply of money. Next, also considered money as store of value. So people holds their nominal income for use in future. Now, the proportion of nominal income held in the form of cash balance by the people is represented by small k, small letter k. So let's recall it till now. People holds their nominal income for use in future. K represents a portion of nominal income held in the form of cash balance. Now we will talk about the Cambridge equation. So Cambridge equation was MD is equal to KPY. Okay. Now here MD represents the demand for money. K represents a portion of income that people wants to hold in cash. P represents the average price level. And Y represents the real national income. So let's recall the Cambridge equation. Cambridge equation is MD is equal to KPY, where MD is demand for money, K represents a portion of income that people wants to hold in cash, P represents the average price level, Y represents the real national income. Now students, we know that at equilibrium, the demand is equal to supply. Similarly happens in case of money. At equilibrium, demand for money is equal to supply of money, that is the money supply. So MD is equal to M. Here MD represents the demand for money, whereas M represents the money supply. Okay. And we know that MD is equal to KPY, right? So from equation 1 and 2, we can say that M is equal to KPY. So money supply is equal to the product of K, P and Y. So let's recall it till now. At equilibrium, demand for money is equal to money supply. MD is equal to M. And MD is equal to KPY. So from 1 and 2, we can say that M is equal to KPY. So this is all about the Cambridge equation or cash balance equation. Now students, we will talk about the Keynesian theory of demand for money. See, Keynes' theory of demand for money is also known as liquidity preference theory, or you can say liquidity preference theory is the other name of Keynes' theory of demand for money. So let's recall it till now. The Keynesian theory of demand for money. The Keynes theory of demand for money is also known as liquidity preference theory. Now students, we will first talk about the term liquidity preference. Now what is liquidity preference? Liquidity preference is the desire, or you can say wish or will of the people to hold money in the form of cash rather than securities. Okay. This is a term, basically the term of liquidity preference was coined by, or you can say was given by John Maynard Keynes in his masterpiece named The General Theory of Employment, Interest and Money in the year 1936. So let's recall it. Liquidity preference refers to the people's desire to hold money rather than securities. Okay. A term was coined by John Maynard Keynes in his masterpiece, that is The General Theory of Employment, Interest and Money in the year 1936. According to Keynes, people hold cash or people hold money in the form of cash for three motives, and those are transactions motive, precautionary motive and speculative motive. This we have already discussed, that what is transaction motive, what is precautionary motive, what is speculative motive. So let's recall it till now. According to Keynes, people hold money in cash for three motives. A. Transactions motives. B. Precautionary motive. C. Speculative motive. Now students, we will talk about the transaction motive. As already discussed, it is basically the need for holding cash for current transactions, or you can say for routine transactions, for personal and business exchange. So let's recall it. Transaction motive. The need for holding cash for current transactions, for personal and business exchange. The transaction demand for money, that is the demand for money which is done in order to do the day-to-day transactions, is directly related to the level of income. That is, if the level of the income of the individual will increase, then transaction demand for money will increase and vice versa. So here's an equation given by Keynes, which is LR is equal to KY. Here LR represents transaction demand for money and K represents the ratio of earnings which is kept for transaction purpose. Okay, or you can say K represents the portion of earnings which is kept for transaction purpose. Y here represents the earnings, or you can say income. So let's recall it. The transaction demand for money is directly related to the level of income. LR is equal to KY, where LR is transactions demand for money, K represents the ratio of earnings kept for transaction purpose, Y represents the earnings. Further, we have Keynes considered the aggregate demand for money for transaction purpose as the sum of individuals' demand, and therefore the aggregate transaction demand for money is the function of national income. So in short, the aggregate transaction demand for money is dependent on national income. If the national income will increase, the aggregate transaction demand for money will increase and vice versa. So let's recall it. Keynes considered the aggregate demand for money for transaction purposes as the sum of individual demand, and therefore the aggregate transaction demand for money is the function of national income. Further, we have the precautionary motive. See students, there are certain unforeseen and unpredictable contingency arise which may lead us the money payments bias. Okay, and this may occur in day-to-day life. Individuals and businesses keep a portion of their income in order to finance such unanticipated expenditure. Okay, that is called the demand for precautionary motive. So, the precautionary motive. Many unforeseen and unpredictable contingencies involving money payments occur in day-to-day life. Individuals and businesses keep a portion of their income to finance such unanticipated expenditure. The precautionary demand for money is basically dependent on so many factors such as size of income, prevailing economic as well as political conditions, personal characteristics of the individual such as optimism, pessimism, and farsightedness. For example, if the size of income will increase, then the demand for money for precautionary motive will increase and vice versa. And if there are favorable economic and political conditions in the economy, then precautionary demand for money will decrease and vice versa. And if the individual is optimistic, then the precautionary demand for money will decrease and vice versa in case of pessimism. Okay, etc. So let's recall it. The precautionary demand for money depends on the size of income, prevailing economic as well as political conditions, and personal characteristics of the individual such as optimism, pessimism, farsightedness, etc. Now students, we will talk about the speculative demand for money. As already discussed, speculative demand for money is basically the demand for money for making money out of money. Okay, for getting the benefits of the gains out of the money. Okay, so speculative motive represents people desire to hold cash in order to be equipped to exploit any attractive investment opportunity requiring cash expenditure, right? Speculative motive basically represents the desire or wish or will of the people in order to hold the cash so that they can take benefit of any attractive investment opportunity available to him which requires expenditure in the form of cash. So let's recall it. Speculative demand for money. The speculative demand represents or reflects people's desire to hold cash in order to be equipped to exploit any attractive investment opportunity requiring cash expenditure. Further, students, according to Keynes, people demand to hold money balances to take advantage of the future changes in the rate of interest, which is same as future changes in bond prices. Okay, so according to Keynes, people like to hold money in order to take the advantages which might arise due to changes in the rate of interest, and it is similar as changes in bond prices. So let's recall it. According to Keynes, people demand to hold money balances to take advantages of the future changes in the rate of interest, which is same as future changes in bond prices. Next, students, we need to note that the market value of bonds and the market rate of interest are inversely related. That is, if the market rate of interest will increase, then the market value of bonds will decrease and vice versa. So let's recall it. The market value of bonds and the market rate of interest are inversely related. That is, if market rate of interest will increase, then market value of bonds will decrease and vice versa. Next, students, generally investors have a relatively fixed conception of normal or critical interest rate and compare the current rate of interest, that is the prevailing rate of interest, with such normal or critical interest rate in order to take the decisions that whether to hold the money in the form of cash or to hold the money in the form of bonds. So let's recall it till now. Generally, investors have a relatively fixed conception of normal or critical interest rate and compare the current rate of interest with such normal or critical interest rate. Students, if the wealth holders consider the current rate of interest as low compared to normal rate of interest or critical rate of interest, then investors expect that the current interest rates will rise in near future and hence the bond prices will fall in near future, right? Then the investors would prefer to hold wealth in the form of liquid cash rather than bonds. Okay, so let's recall it till now. If the wealth holders consider the current interest rate as low compared to normal interest rate, the investors expect the current interest rates to rise in near future, that is bond prices to fall. The investors would prefer to hold wealth in the form of liquid cash rather than bonds because now there are certain reasons behind this. The loss suffered by way of interest income foregone is small. That is, the opportunity cost is small, right? They can avoid the capital losses that would result from the anticipated increase in interest rates. Okay. Next, return on money balances would be greater than return on alternative assets. So let's recall it till now. The loss suffered by way of interest income foregone is small. They can avoid the capital losses that would result from the anticipated increase in interest rates. Return on money balances is greater than the return on alternative assets. Also, students, if the interest rate does increase in future, the bond prices will fall and the ideal cash balances held can be used to buy bonds at lower price and can therefore make a capital gain. Okay, so let's recall it. If the interest rate does increase in near future or future, the bond prices will fall and the ideal cash balances held can be used to buy bonds or purchase bonds at lower prices of the bonds and can therefore make a capital gain. So students, we can conclude that as long as the current rate of interest is higher than critical rate of interest, a typical wealth holder will hold in his asset portfolio only government bonds, right? And if the current rate of interest is lower than the critical rate of interest, then his asset portfolio would consist of cash only. So let's recall it till now. As long as the current rate of interest is higher than the critical rate of interest, a typical wealth holder would hold in his asset portfolio only government bonds. And if the current rate of interest is lower than critical rate of interest, his asset portfolio would consist of cash. Further, we have, if the current rate of interest is equal to the critical rate of interest, then a wealth holder will be indifferent to holding either cash or bonds. That the wealth holder would be equally preferring to hold the money in the form of cash or to hold the money in the form of bonds. From all of this, the demand for speculative money and interest are inversely related. That is, if the rate of interest will increase, the demand for speculative money will decrease and vice versa. So let's recall it till now. If current rate of interest is equal to critical rate of interest, a wealth holder is indifferent to holding either cash or bonds. From all this, the demand for speculative money and interest are inversely related. Now students, we will talk about the liquidity trap. See students, liquidity trap occurs when interest rates are very low and people prefer holding cash rather than investing or spending. So speculative demand for money becomes intact. Okay, so whenever the speculative demand for money doesn't change at all, even at low interest rates, then it is called the situation of liquidity trap. So let's recall it till now. Liquidity trap. A liquidity trap occurs when interest rates are very low and people prefer holding cash rather than investing or spending. So speculative demand for money becomes intact. Here we can see the diagram which is showing the liquidity trap. Here this red portion shows liquidity trap, right? You can see students, at very low interest rate, the speculative demand for money remains same, right? Even at lower interest rate. So this situation is called liquidity trap. Now students, we will talk about the inventory approach to transaction balance. Okay, this theory was given by Baumol and Tobin. This is also known as inventory theoretic approach. Okay, so let's recall it. Inventory approach to transaction balance. This theory was given by Baumol and Tobin. This is also known as inventory theoretic approach. Okay, this model assumes that there are two media for storing value. That is, we can store the value in the form of money or in the form of interest bearing alternative asset. So let's recall it. This model assumes that there are two media for storing value. First, money, and next, an interest bearing alternative asset. Next students, there is fixed cost of making transfers between money and the alternative assets. That is, if anyone wants to purchase or sell the alternative asset, okay, for money or with the help of money, then fixed costs are present and that is called broker charges. Okay, so let's recall it till now. There is fixed cost of making transfers between money and the alternative assets. That is broker charges. Next, Baumol put forward a new approach to demand for money, which explains that the transaction demand for money from the point of view of inventory management. Okay, Baumol said that individuals hold money, that is the inventory of money, for the transaction purpose. So according to Baumol, people do not hold money in the form of cash. They basically should hold the money in the form of inventory. Okay, so people should hold inventory of money rather than to hold the money in cash. So let's recall it. Baumol put forward a new approach to demand for money, which explains the transaction demand for money from the point of view of inventory management. Baumol asserts that individuals hold money, that is inventory of money, for the transaction purpose. According to him, individuals should keep optimum inventory of money, that is the optimal or you can say best inventory of money for their day-to-day transactions. So let's recall it. According to him, individuals have to keep optimum inventory of money for their day-to-day transactions. Now students, if anyone wants to hold the money in the form of cash, okay, then the opportunity cost is the amount of interest foregone by him that he could have earned if he kept their wealth in bank deposits or could have invested it in bonds and shares. So let's recall it. They also incur cost when they hold inventories of money. So people also incur the cost when they hold inventories of money, and the opportunity cost is the amount of interest foregone that they could have earned if they had kept their wealth in bank deposits or could have invested in bonds and shares. Next, money that people hold in the form of currency are very safe as it is in their own hands, right? But it gives no interest at all to the people, right? While the money in the form of bonds or shares provides returns or you can say interest, but are very risky and may involve capital loss. Okay, let's recall it till now. Money that people hold in the form of currency are very safe and gives no interest, while bonds or shares provide returns, that is interest, but are very risky and may involve capital loss. But savings deposits in banks is quite safe and risk-free, right? And it helps in earning some interest as well. Let's recall it. But savings deposits in banks is quite safe and risk-free and earns some interest as well. Baumol and Tobin proclaim that transactions demand for money depends on rate of interest on savings deposit. Okay. So let's recall it. Baumol and Tobin proclaim that transactions demand for money depends on rate of interest on savings deposit. How? Let's have a look. See students, if there will be increase in rate of interest, then people would like to hold less money in the form of currency, right? They would prefer to hold their money in the bank deposits as they will earn good amount of interest on that. And vice versa, that is if rate of interest will fall, then in that case people would not like to prefer to hold their money in bank deposits, rather they prefer to spend their money on the purchase of goods and services, right? So individuals must compare the cost and benefits of funds in the form of money with no interest to that of money in the form of money in savings deposits with some interest. Okay, so according to Baumol and Tobin, the people should compare the cost and the benefits of funds in the form of money with no interest at all and in the form of money with some interest. Okay, so let's recall it. ROI increases, people will hold less money in the form of currency and vice versa. So individuals must compare the cost and benefits of funds in the form of money with no interest to that of money in the form of money in savings deposits with some interest. Now according to Baumol, the Baumol has given the average amount of cash withdrawal which minimizes the cost. So the equation given by Baumol is C is equal to within square root 2by divided by R. This is also known as square root rule. Okay. Here C represents the average amount of cash withdrawal which minimizes cost, whereas B represents the broker's fee and Y represents the size of income of individual and R represents the interest rate. Let's have a look. According to Baumol, C is equal to within square root 2by divided by R. This is also known as square root rule. C represents average amount of cash withdrawal which minimizes cost. B represents broker's fee. Y represents size of income of individual. R represents interest rate. The inventory theoretic approach suggests that the demand for money and bonds depend on cost of making a transfer between money and bonds. That is the brokerage fee. Okay. So let's have a look. The inventory theoretic approach suggests that the demand for money and bonds depend on cost of making a transfer between money and bonds. That is the brokerage fees. How? Let's have a look. See students, whenever there will be increase in the brokerage fees, then it will lead to increase in marginal cost of bond market transactions and consequently lowers the number of such transactions. And if the brokerage fees will increase, then there will be increase in transaction demand for money and which reduces the average bond holdings over the period. So let's recall it. Increase in brokerage fee will increase the marginal cost of bond market transactions and consequently lowers the number of such transactions. Increase in brokerage fee will lead to increase in transaction demand for money and lowers the average bond holdings over the period. Now students, we will talk about the Friedman's restatement of the quantity theory. Milton Friedman extended Keynes' speculative money demand within the framework of asset price theory, okay, in the year 1956. So let's recall it till now. Friedman's restatement of the quantity theory. Milton Friedman in the year 1956 extended Keynes' speculative money demand within the framework of asset price theory. According to Friedman, it is not the current income that determines or decides the demand for money. It is basically the permanent income of the individuals that determines the demand for money. Now, what is permanent income? Permanent income is the present expected value of all the future incomes. That is the value of all the future incomes in the present time. So let's have a look. According to Friedman, it is the permanent income that determines the demand for money, not the current income. Permanent income is the present expected value of all the future incomes. Now, under this theory, money is a good as any other durable consumption good. Okay, and its demand is basically a function of many factors. That is total wealth, price level, opportunity cost of money holdings and inflation. So let's recall it. Money is a good as any other durable consumption good, and its demand is a function of many factors like total wealth, price level, opportunity cost of money holdings and inflation. So Friedman had given 4 determinants of demand for money. That is, he identified 4 factors affecting demand for money. So according to Friedman, the demand for money is a function of total wealth. Now, how do we calculate the total wealth? Total wealth is calculated by dividing the permanent income with the discount rate. So total wealth is equal to permanent income divided by discount rate. So let's recall it till now. Friedman identifies 4 determinants of demand for money. Demand for money is a function of total wealth. Total wealth is equal to permanent income divided by discount rate. Next, total wealth is defined as the average return on 5 asset classes, namely money, bonds, equity, physical capital and human capital. So let's recall it. Total wealth is defined as the average return on 5 asset classes, namely money, bonds, equity, physical capital and human capital. And the demand for money is positively related to price level. That is, if the price level will increase in the economy, then the demand for money will increase and vice versa. And the demand for money rises if the opportunity cost of money holdings decline, right? Let's suppose the rate of interest on demand deposits declines or decreases, then it will lead to decrease in the opportunity cost of money holdings, and hence the demand for money will increase in the economy. People would not like to hold their money in bank accounts, right? They would like to hold their money in the form of cash with themselves. So the demand for money rises if the opportunity cost of money holdings decline, and vice versa. So let's have a look. Is positively related to the price level, that is P. Rises if the opportunity cost of money holdings decline and vice versa. Next, the demand for money is also influenced by inflation. A positive inflation rate reduces the real value of money balances, thereby increasing the opportunity cost of money holdings, and hence the demand for money will decrease, and vice versa. So let's recall it. Is influenced by inflation. A positive inflation rate reduces the real value of money balances, thereby increasing the opportunity cost of money holdings. Now students, we will study another theory of demand for money, that is the demand for money as behavior towards risk. Okay, it was basically given by James Tobin, who is an American economist. In his analysis, he makes a valid assumption that people prefer more wealth to less. Obviously, the people would like to have more wealth to less wealth. No one wants to settle at less wealth, right? Everyone wants to settle at more wealth. So let's recall it. The demand for money as behavior towards risk. James Tobin, an American economist, in his analysis makes a valid assumption that people prefer more wealth to less. Now, according to him, an investor is faced with a problem. He has the problem in deciding that what proportion of his portfolio of financial assets should be in the form of money ready, that is, should be in the form of cash, which will give him no interest, and what proportion of his portfolio of financial assets should be in the form of investment, through which he will be able to earn the interest. Let's suppose bonds. Okay, so let's recall it till now. According to him, an investor is faced with a problem. That is, what proportion of his portfolio of financial assets should be in the form of money ready, and what proportion of his portfolio of financial assets should be in the form of investments. Okay. Now students, he gave the solution for this issue faced by the investors. Okay. So according to Tobin, the individuals or people should prefer to hold a combination of safe and risky assets in their portfolio of financial assets, so that the risk can be diversified, that is, the risk can be spread, and there is a holding of balanced combination of safe and risky assets. It is not good to go only with the risky assets. Also, it is not good to go with the safe assets only. It is good to go with the combination of safe and risky assets. Okay, because a combination of safe and risky assets will lead to diversification of risk, and it is basically a balanced combination of safe and risky assets. So according to Tobin, the individuals should prefer a combination of safe and risky assets, so that the risk is diversified by holding a balanced combination of safe and risky assets. Next we have, according to Tobin, an individual's behavior is to alleviate the risk at the same rate of interest. That is, the individuals prefer to have less risky assets as compared to more risky assets at the given rate of return. Let's suppose there are two projects, project A and project B. Okay, and the expected rate of return on both the projects are 10% per annum. 10% per annum. Okay, and if we talk about the risk percentage, then project A contains more percentage of risk. It is more risky as compared to project B. So the individual would like to invest in project B as the expected rate of return is same, that is there is given rate of return, but yes, the amount of risk is different in both the projects. So the individual would like to hold less risk to more risk assets at a given rate of interest. So let's have a look. According to Tobin, an individual's behavior shows risk aversion, which means they prefer less risk to more risk at a given rate of return. Now students, if an individual chooses or select to hold a greater proportion of risky assets such as bonds or shares in his portfolio, then he will be earning a higher average return, but yes, he is bearing high degree of risk also. So let's recall it. If an individual chooses to hold a greater proportion of risky assets such as bonds or shares in his portfolio, then he will be earning a higher average return but will bear a higher degree of risk. Also, Tobin argues that an individual that is risk averter, the individual that is avoiding the risk, will not choose or will not select such a portfolio with risky bonds or greater proportion of them. Right? That individuals who want to avoid the risk will prefer to have the portfolio with less risky bonds, or you can say with safe bonds or greater proportion of the safe bonds. So let's recall it. Tobin argues that an individual that is risk averter will not choose such a portfolio with risky bonds or greater proportion of them. Next, an individual who wants to take zero risk will not be getting any return, right? Therefore, people prefer to have a mixed or diversified portfolio of money, bonds and shares, with each person opting for a little different balance between the risk and return. So let's have a look. An individual who wants to take zero risk will not be getting any return. Therefore, people prefer to have a mixed or diversified portfolio of money, bonds and shares, with each person opting for a little different balance between risk and return. Now we will talk about the Tobin's liquidity preference function. See students, we know that function is basically something which shows the relationship, right? So Tobin derived the liquidity preference function which shows the relationship between rate of interest and the demand for money. So let's recall it. Tobin's liquidity preference function. Tobin derived his liquidity preference function showing the relationship between rate of interest and demand for money. At the higher rate of interest, the demand for holding money will be less, right? And people will hold more bonds in their portfolio and vice versa. So let's have a look. At a higher rate of interest, the demand for holding money will be less and people will hold more bonds in their portfolio and vice versa. So in this we are going to start with the concept of money supply. Okay. So what is the meaning of money supply? See students, whatever total quantity of money is available with the public, or you can say people living in the economy, is called the money supply in that economy. Okay. Now what does people include? People here is a broader term. People includes all the economic units such as households, firms, institutions such as local authorities, NBFIs, that is non-banking financial institutions, and IMF, that is International Monetary Fund, holding Indian money. Okay. So whatever the quantity of money is available with all the economic units such as households, firms, institutions such as local authorities, non-banking financial institutions, and IMF holding Indian money is called money supply. Now here we need to note that what is excluded under people. Okay, so people excludes the producers of money, that is the government and the banking system. The people doesn't include the government as well as the banking system because these are the producers of money. As we know that the central bank and the commercial bank creates the money in the economy. Central bank issues the banknotes except 1 rupee note and coins, and government issues the 1 rupee note and coins in the economy. So government and the central bank and the commercial banks are the producers of money. These are excluded under people. That is, these are not included under people. Okay. So whatever total quantity of money is available to the people in an economy is called money supply. Or you can say the stock of money available with the public or people in an economy, that is called money supply. So let's recall it. Money supply, total quantity of money available to people in an economy. Now people includes economic units such as households, firms, institutions like local authorities, non-banking financial institutions, and IMF holding Indian money. And it excludes producers of money such as government and the banking system. Now students, here we need to note that supply of money is a stock variable, right? It is not a flow variable because it is measured at a particular point of time. Measured at a point of time, right? Money supply do not have the time dimension. It do not have time dimension. No time dimension is connected with money supply. That is, money supply is not connected or related with the length of time. So supply of money or money supply is a stock variable. It is not a flow variable. Next, stock of money with public is less than the stock of money that exists in the entire economy. Okay. So stock of money with public is basically a subset of the stock of money that exists in the entire economy. So let's recall it till now. Supply of money is a stock variable. Next, stock of money with public is less than the stock of money that exists in the entire economy. Next students, we will talk about the rationale of measuring money supply. Why there is a need for measuring the money supply, or you can say what is the aim or goals of measuring money supply in the economy. Okay, so money supply is measured or calculated in order to assess the economic conditions and formulating the monetary policy thereof. Okay, also it helps the central bank in order to understand the overall liquidity in the economy, and it helps the central bank to track the inflation and other risk in the economy. Next, it is useful for policy makers. Measuring money supply is useful for the policy makers in order to frame the policies, in order to control the inflation and deflation, or you can say in order to frame the policies to bring the price stability. Okay, so let's recall it till now. Rationale of measuring money supply for assessing economic conditions and formulating monetary policy. Next, it helps central banks to understand the overall liquidity in the economy, track inflation and other risks. It is useful for policy makers too. Next students, we will talk about now the sources of money supply. That is, who supplies the money in the economy. So there are basically two main sources of money supply. One is central bank and the another one is commercial bank, that is the banking system. Okay, so students, in all the countries it is a central bank which has been given the topmost power of supplying money in the economy, of basically generating the money for the use of people in the economy, right? So central bank is called the bank of issue because it is having the monopoly power in order to create the money. So central bank is the prime source, or you can say important source of money supply. The currency which is issued by the central bank is called high powered money or fiat money. So let's recall it till now. In all countries, central bank is the prime source of money supply, known as high-powered money or fiat money. Next students, the currency which is issued by the central bank is called fiat money, and it is backed by supporting reserves, and its value is guaranteed by the government. Now what do you mean by that fiat money is backed by the supporting reserves? Students, in every country, minimum reserve system is followed in order to issue the currency by the central bank. Minimum reserve system. Okay. Now what does minimum reserve system is? Minimum reserve system is a system in which the central bank needs to keep minimum amount of reserves in the form of gold and foreign exchange before creating the currency for the economy. Okay. If we talk about the present minimum reserve system, the central bank has to follow the legal requirement of keeping rupees 200 crore, minimum rupees 200 crore reserves with itself. Okay. Out of that, rupees 115 crores must be in the form of gold and rupees 85 crores must be in the form of foreign exchange, forex. Okay, this is called minimum reserve system. So let's recall it. So for issuing the currency, the central bank has to follow the minimum reserve system. That is, the central bank has to keep certain amount of reserves in the form of gold and foreign exchange. That's why we say that fiat money is backed by supporting reserves and its value is guaranteed by the government, means there is a power of the government connected with the fiat money. Okay, no one can disapprove to use the fiat money. Okay, so its value is being guaranteed by the government. So let's have a look. The currency issued by the central bank is called fiat money and is backed by supporting reserves and its value is guaranteed by the government. Now students, we will talk about the minimum reserve system later on, but here we need to note one thing, that currency issued by the central bank, that is a fiat currency or you can say fiat money or high powered money, is the liability of the central bank and the government. Okay. So let's have a look. The currency issued by the central bank is liability of the central bank and the government. Under minimum reserve system, central bank is empowered to issue currency to any extent but by keeping a certain minimum reserve of gold and foreign exchange reserves. So let's recall it till now. Under minimum reserve system, central bank is empowered to issue currency to any extent by keeping only a certain minimum reserve of gold and foreign exchange reserves. Next students, we will talk about the second major source of money supply, which is the banking system of the country. That is, we are going to talk about the commercial banks of the country. As we know that commercial banks creates money supply in the process of borrowings and lending transactions with the public, right? So money so created by the commercial banks is called credit money. In other words, we can say that commercial banks creates a credit money in the economy. That is, commercial bank creates the money by supplying the loan to the people, right? So let's have a look. The second major source of money supply is the banking system of the country. That is credit money. Banks creates money supply in the process of borrowings and lending transactions with the public. Money so created by commercial banks is called credit money. So students, we can say that the high powered money and the credit money constitute the common measure of money supply, or you can say constitutes the total money stock of a country. So let's have a look. The high powered money and the credit money constitute the common measure of money supply or the total money stock of a country. Now students, we will talk about the evolution of money in the economy. See students, the evolution of money is from the commodity currency to digital currency, right? Earlier, commodity currency was in use when barter exchange was taking place. That is, currency in the form of beads, shells were used in order to exchange the goods and services, right? Later on, we shifted to metallic currency. That is, the currency in the form of coins such as gold coins, silver coins, bronze coins, etc. Next, later on we shifted to paper currency. That is a currency in the form of paper notes, such as 500 rupees notes, 1000 rupees notes, 2000 rupees notes, etc. And now we are using digital currency drastically, right? That is a currency in our Paytm, currency in our phone pay, etc. So let's have a look. The concept of money has experienced evolution from commodity currency to metallic currency to paper currency to digital currency. Now we will talk about the CBCD. Now what is CBCD? CBCD stands for Central Bank Digital Currencies. It is basically the legal tender issued by a central bank in digital form, or you can say it is a currency issued by a central bank in the digital form. CBCDs are accepted as a medium of payment, legal tender and a safe store of value, right? So same as physical currency, digital currencies are treated. Like our physical currency is used as a medium of payment, it is a legal tender as well as it is a safe store of value. In the same way, CBCDs are also accepted as a medium of payment, legal tender and a safe store of value. CBCDs would appear as liability on a central bank's balance sheet. Okay, so CBCDs are basically the liability of the central bank. Let's recall it till now. CBCD, that is central bank digital currencies, that is legal tender issued by a central bank in the digital form. CBCDs are accepted as a medium of payment, legal tender and a safe store of value. CBCDs would appear as liability on a central bank's balance sheet. Now students, we will talk about the cryptocurrencies. You must have heard about a Bitcoin. Bitcoin is a cryptocurrency. Now cryptocurrencies are the digital currency which are not issued and regulated by the central authority. Okay, these currencies are not recognized as money. So let's recall it. The cryptocurrencies are the digital currency not issued and regulated by the central authority. For example, Bitcoin. These currencies are not recognized as money. In India, RBI has said that banks or other financial entities cannot cite RBI's 2018 order that barred them from dealing with virtual cryptocurrencies. Okay, in 2018, RBI has ordered all the financial entities, including the banks, in regarding not to deal with the virtual cryptocurrencies. So let's recall it. In India, RBI has said that banks or other financial entities cannot cite RBI's 2018 order that barred them from dealing with virtual cryptocurrencies. Now we are going to talk about the another new topic of this particular chapter, that is measurement of money supply. That is calculation of money supply. Calculation of money supply. In India, the calculation of money supply is done by RBI, that is the Central Bank of India. Okay, there are various ways to measure money supply. That is, there are various ways or various methods to calculate the money supply. The measures of money supply can be different from country to country, can be different from time to time, and can be different from purpose to purpose. Okay, so let's recall it till now. Measurement of money supply. There are various ways to measure money supply. The measures of money supply vary from country to country, from time to time, and from purpose to purpose. Now students, we will talk about the money supply measurement in India. See, till 1967 to 68, RBI published a single measure of money supply. That was narrow measure of money supply. In that, RBI used to calculate the money supply by applying the formula, that is, money supply is equal to currency with public plus demand deposits held by public. Okay, so RBI used to calculate the money supply by summing up the currency with public and demand deposits held by public. So let's recall it till now. Money supply measurement in India. till 1967 to 68, RBI published a single measure of money supply, that is narrow measure of money supply. Money supply is equal to currency with public plus demand deposits held by public. Now students, from 1967 to 68 onwards, a broader measure of money supply called aggregate monetary resources, that is AMR. AMR is the short form of aggregate monetary resources, was additionally published by RBI. Okay, so let's recall it. From 1967 to 68, a broader measure of money supply called aggregate monetary resources, that is AMR, was additionally published by RBI. Now students, from April 1977, on recommendations of second working group, that is SWG. SWG is the short form of second working group. Okay, so on the suggestions given by second working group or recommendations made by second working group to RBI, from April 1977, RBI had started to publish 4 measures. That is, 4 measures were published by RBI for calculating money supply. That is M1, M2, M3 and M4. Let's recall it till now. From April 1977, on recommendations of second working group, that is SWG, 4 measures were published, that is M1, M2, M3 and M4. Now students, we will go through the formulae in order to calculate M1, M2, M3 and M4. M1 is equal to currency notes and coins with the public plus demand deposits with the banking system, that is a current and savings deposit accounts, plus other deposits with RBI. Okay, whereas M2 is equal to M1 plus savings deposit with the banking system. That is, M2 includes all the components of M1 and also savings deposit with the banking system. So as compared to M1 and M2, M2 is a wider measure of calculating money supply as compared to M1, because M2 includes all the components of M1 and also the savings deposit with the banking system. And M1 is the narrow measure of calculating money supply, as M1 includes all those components which are included for calculating M2 also. So let's recall it. M1 is equal to currency notes and coins with the public plus demand deposits with the banking system, that is current and savings deposit accounts plus other deposits with RBI. Next, M2 is equal to M1 plus savings deposits with the banking system. Next, M3 is equal to M1 plus time deposits, or you can say fixed deposits with the banking system. That is, for calculating M3, we will require the values of all the components of M1 along with the time deposits with the banking system. Next, M4 is equal to M3 plus total deposits with the Post Office Savings Organization excluding NSC. NSC is National Savings Certificate. Okay, so let's recall it. M3 is equal to M1 plus time deposits with the banking system. M4 is equal to M3 plus total deposits with the Post Office Savings Organization excluding NSC. Now students, we will talk about the money multiplier. Okay, money multiplier is basically done by the central bank. See students, we know that money is created by the RBI or central bank. Whatever money is being created by RBI is called the monetary base of India, also known as high-powered money or fiat money. Okay, then RBI lends this money to the commercial banks in order to lend the money to the public, right? So banks create money, that is commercial banks create money by making loans, and whatever money is received by the commercial bank from the central bank, it either lends that money in the form of loans or invest its excess reserves to earn more interest. Okay, so as a result of increase in lending capacity of the commercial banks, the money supply in the economy will increase. So let's recall it till now. The money created by the RBI is the monetary base of India, also known as high-powered money. Banks create money by making loans. A bank loans or invests its excess reserves to earn more interest. Now, students, with this we can conclude that a 1 rupee increase in the monetary base causes the money supply to increase by more than 1 rupee, right? So, the increase in money supply is the money multiplier. So, let's have a look. A 1 rupee increase in the monetary base causes the money supply to increase by more than 1 rupee. The increase in money supply is the money multiplier. Okay. For example, if the central bank has injected rupees 100 crores through open market operations, okay, then it will lead to increment of rupees 500 crores of money supply. Then here money multiplier is 500 crores divided by 100 crores, which is 5. That means due to increase in rupees 100 crore by the RBI in the economy, it leads to 5 times increase in money supply in the economy. So how do we calculate the money multiplier? The money multiplier can be calculated by applying this formula, which is money multiplier is equal to money supply divided by monetary base. So in order to calculate the money multiplier, we need to divide the money supply by the monetary base. Money multiplier is denoted by small letter m, right? So let's recall it till now. Money multiplier within bracket m is equal to money supply divided by monetary base. For example, an injection of rupees 100 crores through open market operations by RBI leads to an increment of rupees 500 crores of final money supply. Then money multiplier is 5. Okay. Next, students, we will talk about the assumptions on which money multiplier is based. Here there are two assumptions on which money multiplier is based. First one, banks never hold excess reserves. They either loan their excess reserves or they either invest their excess reserves. But the commercial banks never hold excess reserves with themselves. Okay. Next, individuals and non-bank corporations never hold currency with themselves. So let's recall it till now. Assumptions. Banks never hold excess reserves. Individuals and non-bank corporations never hold currency. Next, students, we will talk about the determinant of money multiplier. See, students, money multiplier is basically the reciprocal or inverse of reserve ratio. Okay, here reserve ratio indicates the CRR as well as SLR. Okay, so money multiplier is equal to 1 upon R. Here R is the reserve ratio. Okay, let's suppose reserve ratio is 5%. Then in that case money multiplier would be 1 upon 5%, which is 100 by 5, which comes out to be 20. And let's suppose R is 10%. Then in that case money multiplier would be 1 upon R, which is 1 upon 10%, which comes out to be 10. Okay. So when we increase the reserve ratio, then we saw that money multiplier decreases, right? So there is inverse relationship between money multiplier and the reserve ratio. The more the reserve ratio would be, the less would be the money multiplier and vice versa. Okay. It is because if the reserve ratio will be higher, then the commercial banks would have less reserves in order to lend to the people. That is, the lending capacity of the commercial banks will reduce, and hence less money will be created in the economy, less supply of money will be there, and due to less supply of money in the economy, the money multiplier would be less, and vice versa. So let's recall it till now. Determinant of money multiplier. Money multiplier is the reciprocal of reserve ratio. Money multiplier is equal to 1 upon R. Now we are going to talk about the theories of money supply. Basically, the theories of money supply tells us or gives us the information about the determinants of money supply. That is the factors on which the money supply is dependent on. Okay. So let's talk about some of the theories related to determinants of money supply. Okay, so there are two alternative theories regarding the determination of money supply. Let's talk about the first view and the second view. According to the first view, money supply is determined by the central bank. Okay, the more the money will be created by the central bank, the more the money supply would be there in the economy, and vice versa. Next, second view. Second view is that money supply is determined or decided by the changes in economic activities. Okay, let's suppose there is decrease in interest rate, then there will lead to increase in the money supply in the economy, and vice versa. And hence, whenever there is decrease in the interest rate, the consumption and investment expenditure in the economy will increase. So, money supply is decided by the changes in the economic activities such as rate, changes in the exchange rate, changes in the rate of interest, etc. Changes in the bank rate, changes in the repo rate, etc. So let's recall it till now. Determinants of money supply. Two alternative theories regarding determination of money supply, that is a decision of money supply. First view, money supply is determined by central bank. Second view, money supply is determined by changes in economic activity. Next, students, we will talk about the other approach or theory to determine money supply, which is money multiplier approach. The money multiplier approach was given by Milton Friedman and Anna Schwartz in 1964. According to this approach, the total supply of nominal money, that is the total money supply in the economy, is determined by the joint behavior of the central bank, commercial banks, and the public. Okay, so in other words, the money supply in the economy is dependent on the behavior of the central bank, behavior of the commercial banks, and the behavior of the public. So let's recall it till now. Other approach to determine money supply. Money multiplier approach by Milton Friedman and Anna Schwartz in 1963. According to this approach, the total supply of nominal money in the economy is determined by the joint behavior of the central bank, commercial banks, and the public. Now students, according to this approach, there are three factors which are the immediate determinants of money supply, and those are stock of high powered money. The stock of high powered money will directly influence the money supply. Whenever there will be high stock of high powered money in the economy, or you can say whenever there will be increase in stock of high powered money in the economy, then the money supply in the economy will increase, and vice versa. So money supply and the stock of high powered money is directly related. Next, we talk about the reserve ratio. Now, what is the reserve ratio? Reserve ratio refers to the ratio of the reserves divided by and deposits. Okay, so R here is the reserve ratio. It is calculated by dividing the reserves by the deposits of the commercial banks. The more will be the reserve ratio, the less will be the money supply in the economy. So reserve ratio and money supply is indirectly related to each other. Next, currency deposit ratio. Now, currency deposit ratio refers to the ratio of currency by the deposits held by the public in the bank. Okay, so currency deposit ratio is represented by small c. Small c is equal to C upon D. Here C is currency and D is deposits. Okay, as there is a relation, money supply and currency deposit ratio is inversely related to each other. That is, whenever there will be increase in currency deposit ratio, the money supply in the economy will decrease, and vice versa. So let's recall it till now. According to this approach, three factors are immediate determinants of money supply, and those are stock of high powered money, reserve ratio, and currency deposit ratio. Now students, as I already told you, the behavior of the central bank, the behavior of the commercial bank, and the behavior of the public determines the money supply. So first we will talk about the behavior of the central bank. See students, the total supply of money, or you can say the total supply of nominal money in the economy, will vary directly with the supply of the nominal high powered money issued by the central bank. Right? As already discussed, the total money supply and the stock of high powered money in the economy are directly related to each other. As the stock, or you can say supply, of nominal high powered money issued by the central bank increases in the economy, then it will lead to increase in total supply of nominal money in the economy. So let's recall it till now. The behavior of central bank. The total supply of nominal money in the economy will vary directly with the supply of the nominal high-paid money issued by the central bank. Next, students, we have behavior of commercial banks. See, the behavior of commercial banks is reflected by the reserve ratio. As already discussed, whenever there will be increase in reserve ratio, the money supply in the economy will decrease and hence the money multiplier will decrease and vice versa. So let's recall it till now. Behavior of commercial banks. It is reflected by reserve ratio. Reserve ratio will increase, then money supply will decrease and money multiplier will decrease and vice versa. Next, here we are having the concept of excess reserve. As we know that students, commercial banks are required to maintain two type of reserves, and those are SLR, statutory liquidity ratio, and CRR, cash reserve ratio. So required reserves are SLR and CRR. But if the commercial bank is maintaining the reserves which are greater than the SLR and CRR, then it is called excess reserve. Excess reserve is calculated by applying the formula excess reserve is equal to total reserves minus SLR minus CRR. Okay, excess reserve is the difference between the total reserves and the required reserves. The banking system's excess reserve ratio is negatively related to market interest rate. Okay, that is, whenever the market interest rate will increase, then the banks would like to hold less of their excess reserves, right? And vice versa. So banking system excess reserve ratio is negatively related to market interest rate. So let's recall it till now. Excess reserve is equal to total reserve minus SLR minus CRR. Required reserves is SLR and CRR. The banking system's excess reserve ratio is negatively related to market interest rate. Next, we will talk about the behavior of public. See students, the behavior of public also influences the money supply. It is reflected by CDR. It is basically the measure of the proportion of the currency held by the public in relation to demand deposits in the bank. Okay, so let's recall it till now. The behavior of public reflected by CDR, that is currency deposit ratio. It is basically the measure of the proportion of currency held by the public in relation to demand deposits in banks. Students, as I already discussed, CDR and money supply and money multiplier are inversely related to each other. That is, whenever CDR will increase, the money supply will decrease and money multiplier will decrease and vice versa. That is, CDR will decrease, then money supply will increase and money multiplier will increase. So students, when bank deposits are being converted into currency, that is whenever the bank deposits are being withdrawn by the people who are holding those reserves, who are holding those deposits, then the banks will be able to create less credit money as earlier and vice versa. So this is the reason, that is why the currency reserve ratio is inversely related to the money multiplier. So when bank deposits are being converted into currency, banks will be able to create only less credit money and vice versa. Now students, time deposit demand deposit ratio also affects the money supply in the economy. Now what does time deposit demand deposit ratio indicate? It is basically the ratio of the time deposits and the demand deposits. It shows how much money is kept as time deposits, or you can say fixed deposits, as compared to demand deposits. Okay, so let's recall it till now. Time deposit demand deposit ratio shows how much money is kept as time deposits compared to demand deposits. Time deposit demand deposit ratio is equal to time deposit divided by demand deposit. Now students, time deposit and demand deposit ratio is directly related with the money multiplier. That is, whenever the time deposit and demand deposit ratio will increase, then the bank will have more deposits in order to do the money supply, right? So they will create more credit money by supplying the loans to the public, and hence the money multiplier will increase and vice versa. So let's recall it. TD divided by DD increases, then money multiplier will increase and vice versa. Now students, we will talk about the other formulae to calculate the money multiplier. Money multiplier is calculated by this formula also, that is M is equal to 1 plus small c divided by R plus small c, where C is basically currency deposit ratio. So C is calculated by dividing the currency by the deposits, okay, or by the demand deposits. Next, R here means reserve deposit ratio. That is, R is equal to reserve divided by deposits. And if there are excess reserves, then M is calculated as M is equal to 1 plus C divided by R plus E plus C into H. Here H is basically high powered money and E is excess reserve ratio, which is calculated by dividing the excess reserve with the deposits. Okay. And R we know about, it is the reserve deposit ratio. Okay. And C is the currency deposit ratio. So let's recall it till now. Other formula, M is equal to 1 plus C divided by R plus C. And if there are excess reserves, then M is equal to 1 plus C divided by R plus E plus C into H. In this, we are going to talk about the effect of government expenditure on money supply. Okay, or you can say effect of public expenditure on money supply. See students, whenever the central government or the state government falls short of their cash balances, then they need to take the loan from the central bank. Okay, so they are eligible to avail the loan from the central bank under the facility called ways and means advances. Okay, let's recall it till now. Effect of government expenditure on money supply. Whenever the central and the state's government cash balances fall short of the minimum requirement, then they are eligible to avail of the facility called ways and means advances. Okay. Now students, whenever RBI lends the governments, then it leads to generation of excess reserves. That is excess balances of commercial banks with RBI. How? I will let you know in the later phase. When RBI lends to the governments, it leads to generation of excess reserves. That is excess balances of commercial banks with RBI. See students, whenever the government incurs the expenditure, then government balances with RBI is debited, right? But to whom the payment is made? Let's suppose the government is paying salary to its employee, okay? Then there will be credit done in the receiver's bank account, and that bank account is with the commercial bank. The receiver's bank account, that is the salary account of the government employee, is with the commercial bank, right? So the reserves will be created with the commercial bank. So there will be excess reserves with the commercial banks, and we know that the more the reserves with the commercial banks, the more money will be created, the more money supplied in the economy, right? So the money supply in the economy will increase. So let's recall it till now. Government incurs expenditure, government balances with RBI debited, and crediting the receivers, for example, salary account of government employee account with commercial banks. This will lead to excess reserves of the commercial banks, and it will increase the money supply in the economy. Now students, we will talk about the credit multiplier also. Credit multiplier is also known as deposit multiplier or deposit expansion multiplier. See students, we know that commercial banks create some money through the process of borrowings and lendings, right? So whatever amount of additional money created by commercial banks through the process of lending, the available money it has in excess of the central bank's reserve requirements, that is the money that it has in excess of the reserve requirements, that is the SLR and CRR, then it is called credit multiplier. Okay. Basically, it is the base of the credit multiplier. The credit multiplier or deposit expansion multiplier describes the amount of additional money created by commercial bank through the process of lending, the available money it has in excess of the central bank's reserve requirements. Okay. So how do we calculate the credit multiplier? Credit multiplier is calculated by applying the formula, which is credit multiplier is equal to 1 upon required reserve ratio. Okay, that is 1 upon the combination of SLR and CRR. So basically, credit multiplier is the reciprocal of the required reserve ratio. The more the required reserve ratio will be, the less the credit multiplier would be, and vice versa.